Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Tuesday edition of After the Close. And of course, we only host it on Tuesday, so it better be a Tuesday. Thanks for being here, everybody. I'm your host, Kevin Horner. We are going to take a look today at some moves in the market. I mean, we actually have some red on the screen as we close the market here today on this Tuesday. We're going to kick off the show with a look at our major indices and see how the levels to which we have pulled back. We'll maybe find some opportunities on potentially on the bearish side, potentially on the bullish side. And as usual, we've got to review what we did last week as well. Turns out we didn't get put into positions on all of our trades, so we'll see where we were capable and where we weren't. Look at a little bit of those charts, and of course, get you some new examples based on today's action heading into tomorrow. So with that, take a moment and say hello to, well, I'm not joined as of yet in the chat. I am expecting to be joined in the chat by Barb Armstrong here momentarily, but when she gets here, make sure you say hi. You can follow us on X, Barb Armstrong CS, Kevin Horner CS. Easily the best way to meet up with your coaches outside of the classes we offer you here on the channel. So you are welcome to reply to any of our posts. We try to follow up with you, of course. One thing we will never do on X, we will not reach out to you directly. So please know that we won't do that on a proactive basis. So it's very important you know that, because there are many imposters out there, unfortunately. We all need to be diligent in our process, but no, none of the Schwab coaches or personalities, if you will, we will not proactively reach out to contact you. So that can be one thing to bear in mind as you go forward there on X. All right. If you're not already doing so, you do want to make sure you're subscribed to the Schwab YouTube channel, of course. We call it Trader Talks. And beyond the live content we house for you and make available every day, you have about 90% of that content available on an archived basis. So love to have your follow there as well. Let's cover our disclosures, and then we'll get into the fun stuff for you all today. Please remember that our discussion here is exclusively informational and educational. We do not make recommendations. We do not endorse a specific approach or process to trading the market here. We do try to offer you up some insights to your own process, though, try to give you ways to think about trading the market, things that traders want to be cognizant of, and strategies you might choose to implement on your own process. As we talk technical analysis, we remind you that this is merely one of your decision-making pieces rather in the puzzle. We do not think you should make decisions exclusively off any one single thing, certainly not basing all decision-making off technical analysis exclusively. Now, today we will be incorporating options, so it's important to know that options carry a higher level of risk. They are not appropriate or suitable for all traders and investors. In order to trade options at Schwab, you do need to be approved on each account in which you would like to trade options, so make sure you go through the requisite steps to be approved personally. Okay, make sure you're doing that on each individual account. All right, so with that, let's go ahead and take a look at the S&P 500, which did fall to a level of short-term support, a level that many trader has been talking about, that 20-day moving average. We've been very limited in our drawdowns below the 20-day. Today, we basically closed on it. Our level 67.71, and if I expand my view here, I find that the 20-day moving average resides at 67.47. So, hey, we've got still a ways to go if we want to test the 67.47 20-day moving average, but looks like an important level nonetheless. It was prior highs, can act as current support. We'll find out if that'll maintain. Now, if not, the 50-day below us, 66.54, that's about 115 points away. That bears watching as well, as does the last line of defense. And I call it that because that was our last low that we made in a time frame commensurate with the 50-day. It goes all the way back here to the October 10 Friday bottom, almost a little more than 3 weeks ago, of course. And so what are we wanting to see is if we violated the 20 on a close, if we take out the 50 on a close, that we find a way to provide horizontal support at about 65.40, because that would once more be matching lows. And matching lows are fine. Lower lows, not so much. So we're trying to avoid those lower lows. I saw you earlier, Jay, talking about the concern around the 50-day moving average, not wanting to visit it, not wanting to break it. I totally understand it, but we don't get to say, right? The market is right 100% of the time. We are not trying to be smarter than the market. We're just trying to trade with the directional move of the market as best we can, try and stay on the right side of things. So far, you do not have a break of the S&P trend. Now, one of the things that might be pertinent or helpful here is just to give thought to the length and longevity of our move. If we go back to the bottom that we made in early April, and if this is in fact a top, could we also find a level of support somewhere in the 6,400 neighborhood? We sure could. So something, we shouldn't be surprised to maybe see a pullback. This might not be the ultimate end to our bull market. We don't know, but we as traders need to be prepared so that we can know what we want to do. How do we want to act if we find these levels, right? So I have been stating for a while that my encouragement to traders isn't just to set levels to which you think the market can fall. It's to actually look below those levels that you think the market can fall to, because inevitably when you set your line in the sand and you think that the market's going to hold up there and that's the lowest that you've evaluated, well, that's when you're going to have your thesis checked pretty quickly, right? I don't think it can fall through the 50-day. Well, that's when we will, and we'll have to find support below it. Where will that come into play? Will you as a trader be prepared for that test of support, that potential for a bounce at that level? We don't know what it's going to be, but you got to be prepared and you got to give it some consideration, give it some thought. So we could very well see a little bit of bleed through or follow through with today's selling, but we stopped above the 20-day on the SPX, so we're not going to go too far here in our thought process. Now, things don't look quite as optimistic necessarily in the NASDAQ 100, because as you can see here, we fell through an area that we would have liked to have held, and that was this gap. Essentially what you've got, if we looked at this on like a 4-hour chart, I find this to be a little bit instructive. Look at essentially what we did in here was, I'll lift this line and just draw it like so through this bottom right through here and this top right through here. And so suddenly all of this action kind of looks like it's all by itself in what some traders might call a bit of an island up here. Forget the back and forth within it. The fact that we are outside of all of that drawing area tells us that what led to the gap is no longer the narrative of the market right now. Now we have to put ourselves back into that range. So if you're bullish, you'll want to force the market to do that. Don't expect the market to do it. Force the market to do it, and then you can start believing that there's more upside. But you got to get back into any of this price action before. It's much more likely now, and I say likely because we talk about probabilities. That's what we're balancing here. Now that we've fallen through all of this action that we made last week, the most likely reaction to this is a bounce into resistance and a potential rollover or failure. That's what we should be prepared for. And if the market does something other than that, well, then bully for us. That's great. That's what we want. But we can't necessarily expect it. I think traders should be maybe a little bit paying attention to this action and defining it as a little more likely for bearish action in the near run rather than bullish action in the near run. Doesn't mean we can't get bullish from here. Okay. In fact, there's a decent chance that tomorrow you get a little bit of optimism. Oh my goodness, we pulled back to a level I'd like to buy. Let's step in and see if we can participate. That's possible. Right? Could we? Is anybody surprised that we fell to the gap high here? You shouldn't be. because we know the importance of gaps, right? So tomorrow's action could easily start green and lead us back upward into, say, 25,750 again, but be prepared for that to not necessarily hold. Okay, so we got to be aware. All right, so breaking down on the NASDAQ, not necessarily near the 20-day just yet. We're a ways off. The 20-day resides at 25,228. So we're about 200 points from that on the NDX here. Okay. All right. Now, how about the small caps? Small caps, unfortunately, are taking it on the chin today, almost 2% lower, 1.75%. Significant action here as we did close below the 50-day moving average. That is our first close below it. Go back to when we tested it last year in August on the 1st. Our close that day was 21.66, and our 50-day that day, oh, excuse me, I'm wrong. We were actually below it by 2 points that day. 21.66 was our close, 21.68, almost 69, our 50-day moving average on that day. So technically, we've had one close below it. But some traders would say that this candle does not resemble this one. And that's because today we essentially closed at the low of the day. All right. Hey, you guys are talking tacos and fajitas and so forth. Knock that stuff off, man. That's my job. That's what I do when I'm in the chat. You can't talk tacos while I'm here hosting, man. That isn't cool. Now you got me thinking food again, Will and Ricebird. You guys, you usual suspects causing me all kinds of consternation here in the afternoon. I should have eaten lunch is what I'm getting at. I should have eaten before show. All right. Russell 2000, a little precarious. All right. Now, today, I thought it pertinent. If we are bullish, then we need to look at some areas of the market that might offer bullishness. So today, what held up? Let's look at our sectors. Today, we had some leadership from, should not be surprised, consumer staples. So let's see. Consumer staples held up, are at least getting a bounce today after having undergone a very ugly drawdown the last couple of weeks. So we'll make note of that. What about healthcare? Holding up. Okay. There's another positive from a group that has taken on money in the midst of the selling in tech. We can also see financials holding up okay. Still a little rangy in financials, but maybe we have some stocks providing some leadership in that space. Now, for bearishness, we probably are not surprised. Our former leaders bled a bit today. Let's look at our consumer discretionary. Hold back. That does not look ideal. This looks like a one-day island reversal. That is a little less than stellar, to say the least. Getting under the low we made on Friday of last week will be less than desirable for this group. So discretionaries could be in the midst of a bit of a drawdown, a bit of a pullback. Maybe my white line, former all-time highs, can hold up and provide support. We'll see. What about tech? We're going to see that not looking fantastic, but it doesn't look horrible. We're not going to overdo it here because, again, our leadership has been strong. So while we might look for bullish trades in alternate areas, some of those defensive groups, we're not necessarily wanting to look for bearish trades in tech just yet, at least not based on what we've seen here. This looks like a fairly standard pullback at this point. Might be too early to suggest any more than that. Our last high, when we made it here in tech, we also made a higher high in the RSI versus the last ones here. So let's not overdo things just yet, okay? Now, we are seeing communications draw down a little bit. That one's a little tricky here now that we're at the 50-day, but that could be an interesting spot. All right, so what I thought we would do today is lean in to one of the standard screens that I'll often utilize for you all here and after the close, and that incorporates groups making higher highs, higher lows, but also having already pulled back. So let's do that. We call this one my uptrend and oversold is the name of it. So I'm going to go in here to uptrend and oversold, this first one. Okay, now I've got a few of those, uptrend and oversold, incorporating a 20-day moving average or a 200 or a 50. This is just considered uptrend and oversold. I'll quickly give you a rundown of our process here. This is looking for stocks with average volume of at least 500,000 shares, where a 10-day moving average is above a 50 is above a 100, and we've got a stochastic indication that the slow stochastics are under the 35 line, which is what signals for us that we've got stock that has pulled back to an area of potential support. So what we're going to do here is scan in the S&P 500, but knowing what we know about today's price action, we're going to do it for a couple of other groups. So we're going to start with not tech or anything like that, but let's start with financials. So I'm going to intersect with financials, and let's see if we find any stocks here in this group. Okay, so we've got Block, XYZ. All right, so I mean, what do we see here, everybody? We've got a bit of a lengthy consolidation, I might suggest. Something I could put a little rectangle on in here. We've basically been about 71 up to 81. We'll call it, let's call it 10 points. Basically a 10-point range since mid-July. So yeah, you're looking at almost, 3.5, almost 4 months. Difficult to necessarily do much with this at this point. I could certainly understand a trader maybe taking a long equity position based on this pattern, but it's not trending at the moment. So why would an equity trader take a position of just shares here? They'd be thinking, I've got limited downside. Maybe they'd be thinking about moving on only if we took out the 200-day moving average. That is at 69.23. So that means that the trader here might be risking about $3, maybe $4 to the downside if they admit that they were wrong. If the stock traded under the 200 or closed below the 200-day moving average, maybe they move on. But the upside from here could be 81, could be 82, and that leads you to maybe upside of about $9, 8 to 9, maybe even 10, just from the idea of moving from the bottom of the range to the top of the range once more. Right? We've seen that play out a few different times over the last 3.5 months. So if the trader felt confident about that, I could certainly understand owning individual shares. But the stock is not trending. It's not working against a speedy moving average right now. So, like the 20-day, which is ultimately what a trader might be looking for. So I think this one we can move on from for the immediate future. We're also going to need, because we scanned in the S&P 500 financials, we only got one. Let's change financials and let's go on to healthcare. All right, that's a little more like it. There's some names we're familiar with: AbbVie, Merck, Johnson & Johnson. There's Danaher, CVS Health. Let's see if any of these charts jump off the screen at us, everybody. So we'll lead with AbbVie. Well, I don't know about you. That looks it's a good spot. Could certainly be a good spot, right? We are below the 50-day moving average for day 3. I could suggest a trader might be willing to take a shot here. Doesn't mean that that it's an ideal one. I could, I often say, everybody, if I have to draw too many lines, or if I work too hard to build a trade around the chart, then it might mean that the chart isn't speaking to us just yet. This one could work out. Doesn't quite have a screaming nature to it for some traders. And the fact that we are but 3 days below the 50-day might make traders a little bit uncomfortable. Maybe you want to see a little bit more. Let's take a look at Merck. Yeah, something similar, right? We know we're in the midst of a downtrend because we've got that 200-day moving average in blue sloped pretty aggressively from the upper left to the lower right, and we are right now below it still. So from a bullish standpoint, I think that remains a wait and see. What about Johnson & Johnson here? That's a bit better. We are below the 20-day, but we are holding the 50, and the 50's been nicely upsloping. We had a little bit of a consolidation that allowed us to continue the uptrend, and this one, as a pullback, is a little bit steeper, right? But ultimately, the 50-day moving average could provide that support for us. So the reason, again, that I'm leaning this direction, everybody, in terms of these sectors, defensives, because they're the ones that got the relative strength today. Doesn't mean we're ready for leadership from these groups, but it might give traders a reason to look for opportunities over the coming 2 to 4 weeks, for example. And I do want to mention, I'm going to be out next week, so when we are doing these trades for today's class, we're going to look a little further. We're going to go more than just 1 week out. We're going to go at least 2 so that we can ensure to be ready to go when I return in 2 weeks from today. And we'll talk about our position that we put on here today. So I think, let me see if there's anything else from my scan that really just, let's hit up Danaher. Well, that's a little bit better. That's at least a little bit interesting here, everybody. Let me draw some stuff on this one for us. Danaher had broken out on an earnings move here. So we had an earnings gap after a bull flag. So we got a drawn in bull flag, okay? And then you had a little bit of an inkling that the bull flag was going to continue bullishly for 3 days here. So even if you weren't sure about earnings and you wanted to buy based on the 3 days outside of the flag, some traders would have picked that up just on that. Now you got the rally to a wonderful level, 235, and all we've done is just pull back to support. So this is an interesting spot because it's a 20-day moving average. It's also the low or the high rather before the big gap up. So you had a gap move, a pullback to gap support. This could be something to set up for a trade to the upside, in which case I probably am leaning in this example towards like a long call vertical scenario. So let's build for DHR a long call vertical here, and then we'll look at a secondary option for us in another example. But I want to extend my line that I just put in for support, and just notice these old price action levels matter, everybody. Look left to confirm right is what our friend Ben Watson likes to say. And you can see why. I mean, it was resistance here, and it was clearly resistance a number of times back here, right? So this level, resistance, now support. Okay, so that's what we're striving for. And when we've got multiple reasons for considering it support, well, then we've got a lot of reason to maybe build a trade around it. You've got confluence of data at a number of key levels. The 20-day, a gap zone, prior resistance, now potential support. All of that kind of speaks to the idea that the stock could hold this 210 zone. So maybe a trader wants to build a call vertical spread, being willing to cap some upside opportunity so that they can pat themselves on the back and take a good trade here. We'll see if it plays out that way, but we got to give it some time. So we're thinking about a 210 level of short-term support, and above us, what could we look to rally into? Well, the last level of highs that we really pulled back from was right about 223 or so. So maybe we're talking about a 210 to 220 potential spread idea. What do you think, everybody? Does that sound like it'd be right in our window of opportunity? We've got about a 13-point range ballpark. I mean, we are last today at 214 almost. Support down here around 210-ish, 212-ish. But remember, on the long side, when you're thinking about acquiring or buying a spread like this, the trader is probably leaning into something a little bit more higher, a little bit higher in the way of delta. So delta, the higher delta reasoning, of course, is that the trader wants something that's going to move more dollar for dollar, and it's also going to give them not just dollar for dollar, but an opportunity that the contract has value at the conclusion of the trade, right? Because the delta is two separate measures. One, the percentage movement we expect in the contract relative to a $1 move in the stock, but it's also considered the percentage of likelihood that that contract will be in the money at option expiration. And so if we look at the 200 2 weeks out, 82-cent delta, which implies an 82% likelihood that that contract will be in the money. And some traders feel comfort from that because it tells us that they might still have value at the end of that trade. So if we were thinking a 10-point spread, buying the 200, selling the 210. Nope, I said 210 was our level. Excuse me, everybody. Go back to that. Yeah, 210, Kev. What are we doing? Sorry, everybody. We're still looking with a higher delta, in this case, in that middle range, right around 64 cents or 64% likelihood. So it's a 64-cent delta on the 210 call, and then the 220 call on the other side, we can lock in for what would be, let's see if we can get in there for $5. Well, then we're spending 5 to make 5, right? So you've got a 1-to-1 risk reward ratio on the trade, if that's what we're thinking about. And, you know, again, your 210 has a decent likelihood of a 2/3 percentage, or 2/3 of one, 2/3 likelihood, 66% almost of being in the money at expiration. So 210 by 220. And if we can get in there for $5, that's ideal. Now, the trouble is we set a limit last week on one of our trades and it didn't go. So we just missed out on our opportunity. Now, you have to be thoughtful of that, traders, because you guys, hey, we're looking at all of this after market close. So our alternative is to build a padded limit. That means you might exceed where the mid or the natural resides by a little bit and then try to get yourself into it. So you might not think that the limit should go to 550, for example. And if it opened at a natural of, say, 510, you're still going to pay the lower rate, right? But the padded limit gives you that opportunity for it. I want to address your questions here, Rocco. Why choose the short term? This is typically what I think in this scenario, what a trader's liking to do is try to keep it within 2 weeks of window, right? Maybe you, and like on a Tuesday like today, we wouldn't go to this Friday. We might go to the following Friday. Commonly, that's a window that many traders might explore. In my case, we're going to the subsequent Friday to take advantage of my time away. I'm hopeful that I can still see this trade working when I return. So that's one of the things. But I do think it's important, and I've not addressed it today, but we should be considerate of, are these contracts ones that are big, meaning are they active? Open interest of more than 1,200 and 1,000 contracts respectively tells us that we've got enough to work with here. So this trade, you know, we'll give it a padded limit. Let's kick it up to 5 1/4 in the hopes that we can get that trade put on. Now, this is a really good question. It looks like I'm not, I mean, is it roar? Is it iRoar? I think it's iRoar or something along those lines. Your question about what to watch for while I'm gone. A great question. I really appreciate it. So I'm going to submit this and I'm going to explain my walk away here. We're spending 5 1/4 for the potential, up to 5 1/4, no more. Our cost won't exceed 525. If it is, we won't be put into it. So our max profit becomes 475. Now the question is, how much of that max profit should we be willing to take? Well, that often comes down to a trader's preferences, right? So the encouragement I'll make is to set a percentage of return relative to expectations that you're comfy with. 475. If you woke up one morning and and it's only 2 days later, maybe you're thinking and profit of 375 when my max profit is 475. You're risking the existing profit of $375 for the opportunity to make 100. Today, you're risking essentially 500 to make 500. But in a profit situation where you're already profitable by 350, 375, you got to shift your mentality. I have X dollars in pocket if I sell it right now. And if I don't, I can only make Y dollars more. Balance those two, right? I'm making 375 if I sell it right now. If I hold it, I'm now risking 375 of profit for the chance to make another 100 or 125. Okay? Ask yourself those questions. And you won't be shocked necessarily, but I believe you'll get the response that will aid you in making a decision at that moment in time. For a lot of you, reaching 50, 60, 70% of your expected max profit is going to be a reason to take those profits. All right. And I know Barb speaks quite a bit about early profit taking with base hits rather than staying on your trade for what could amount to home runs, because we don't know what could happen. In fact, when we get to our monitoring of the example portfolio in a couple of minutes, I'm going to show you exactly why you might do something like that. Okay, so there's a trade in Danaher based on the charting of it. Let's also do, I wanted to share this scan for you, Thea. Yeah, absolutely. I'll just share this scan. Give this one a name, everybody. Remember, this one I've called it uptrend and oversold. Please remember that scans shared here, these are not a guarantee for timing, not a guarantee for accuracy. They are also not a recommendation for your use. Okay, let's change off of healthcare and let's take a look at staples. Hit scan here. Yep, and we've got some charts that are probably going to give us something to work with. Let's look at Walmart. So here's Walmart. Now, this one, it had been in a bit of an uptrend. It had been new highs here recently. If I extend my trend line to capture these lows, some traders would say that this has been a successful test of the trend line. The last time we hit the trend line, we moved off of it quite well. And yes, we're below the 50-day, but we've been below the 50-day a number of times. So maybe the 50-day is less important here on Walmart. This is a potential opportunity for a build of an example trade. And let me show you why. If I just move my line of support down here, check this out. Captures all of these peaks that became support and potential support. So maybe that can work right here. But I think the one that jumped off the screen a little bit more for me this afternoon was Monster Beverage, because here you do have a successful test of the 50-day, and the action now in the last 4 days seems to validate the 50-day, doesn't it? We haven't closed above the high of our low day yet, but it does feel as though we found the 50-day. And if nothing else, like we often say, you got to take your chances when presented. 4 days of holding lows at an area that has been supportive. Notice the last time we were at the 50, we got a nice little hammer candle here, and it was upside from there. Nice little hammer candle today. Technically, didn't close above the high of the low day, but it does stand out. So let's build a bullish trade here from an example standpoint on Monster. Now, Monster, we have to know, hey, they've got earnings in a couple of days. So you got to be aware of that. So in this case, everybody, I mean, we can put a trade on. It's going to be a little precarious as to what comes from here. So the trend suggests that we consider a bullish opportunity. But I want to mention it because with earnings, we don't know what could happen here, right? So if you're not feeling bullish due to reason A, B, and C from a fundamental standpoint or based on earnings expectations, perhaps you build something different. But we're going to do it based exclusively off of the pattern and the setup. We will also go out a few weeks in this case to, oh, look at that. Monster doesn't give us weeklies, so we don't have a choice in the matter. We have to trade the November 21s for the monthlies if we want to participate at all. So we reside at just shy of 67. 67.50 contract has a 50-50 delta here, 50-cent delta. You might want to go a little deeper in the money, maybe the 65. And based on what we've got here, I mean, 65 and 7, I mean, yeah, last low at 65 here. Highs were barely through 70. So maybe it's just a $5 spread, everybody. 65 by 70, and we just go for it and see what happens. The good news is, when we do such a thing, it's not going to put us head over skis, right? We're only going to risk what we're comfortable losing. So let's consider the 65 call, the $5 $2.50 entry for a $5 spread means we're risking $2.50 to make $2.50. Okay, so let's put this one on in the hopes that we can get a trade working for the earnings coming this week. We'll see how that goes. And like I said, we're going to kick that up to 2.5 and see if we can get put into the trade. All right, so $5 wide spread for the November 21 expiration, costing us approximately $2.50. All right, let's take a look at what happened last week. Last week, we tried to put us in, I'm so disappointed. We tried to put us into a trade on toast. I was leaning bearishly, and the bear lean was valid, but take a look here. We talked on this day, everybody, the 27th, and the stock had not broken down. Unfortunately, our order to execute, we went and did not give enough of a padded limit, which is why I've been building in a little more padding on our buy order limits here today, because we did not get put into this trade. I was so disappointed. We had a setup that would have worked out beautifully. So we had tried to buy the long vertical for $2.75. We were going to buy the $40 put and sell the 35. It was going to cost us $2.75. We couldn't get into it at $2.75. It was higher than that all day. And unfortunately, I had only placed it as a day-only order, so it expired. So we missed out. And look at what we could have done, because the stock had traded at its lows since that session. The low had been 34.14. So if we were live and in the moment, paying attention to the breakdown, we would have had an opportunity for nearly a full profit trade. I'm really disappointed that we missed out on that one. The stock broke down as we may have expected, continued the downtrend, had a rough start the very next Wednesday morning, hence we didn't get into it. But boy, it would have worked out beautiful. The one we did put on, though, happens to be Broadcom. And the trouble with Broadcom, everybody, is very simple. While we put it on, I wasn't managing it. So what did we do? We opened up a long call vertical 363.80 spread. Cost us $11.20 to put it on. Let's look at our chart on Broadcom and see what happened here. I'm going to put up my trades. Let's see if it puts the trade in there. I don't think it will, because there were options. So we ended up buying the contract. The problem was that I wasn't watching it in the moment here in my example portfolio. And so what do we have now? Well, we have a trade that has now went from being wonderful and working in our favor to working against us. So we are still in the spread. Now, the thing I'll point out here, everybody, is that we have value associated not with the 380. The 380 contract only is worth 47 cents, right? So we have sucked out as much of the premium associated with the 380 as possible. So that is basically going towards covering that cost that we spent to buy the 360 call. So now at this point, it makes perfect sense to go ahead and just buy to close tomorrow morning, not the whole order. We don't want to cover the whole thing because we've got Wednesday, we have Thursday, and we have Friday. But at this point, we only have $47 left in our short call. And we have $365 remaining in our long call, according to this, right? So, yeah, we paid a lot more for it, but we can now let that ride and take the lid off of our upside. So if by some grand scheme, AVGO was to open tomorrow, excuse me, not tomorrow, because tomorrow we're going to cover, we're going to buy to close our 380 call. So I'm just going to do that, buy to close the 380. And I'm just going to leave it at the natural, the 50-cent natural. So tomorrow, let's say we get out of that and then something newswire hits. Well, then our 360 is still live and we can still get upside opportunity from the 360, right? So that's why we're going to close out only one side. You don't have to close the entirety of your spread together, right? And there's no reason to right now, unless you felt that you needed that remaining 350 that resides there for the next 3 days. If you did not like the makeup of this chart, I could understand that. Some traders would say, hey, you're sitting on the 20 and I don't like the pull down. I don't like the drawdown to the 20-day. I think it's more likely to get to the 50 than it is to hold up over the next 3 days. Some of you would look to close the spread and take your remaining few $100s, and I wouldn't fault you for doing that. So that is also an opportunity here, okay? But in this instance, I have to point out that having eroded all of that premium on the short side, it makes sense. Just go ahead and take the cap that you now have on this spread, just take that cap off. And sometimes you'll get lucky. Sometimes that stock will rally and it will continue through that strike. And then you've got more premium or more profit than you realized yet on any opportunity for. So just one consideration. Remember, you can do this on any of your option spreads. You do not have to close those out together. You can always leg out of a contract situation, assuming your balances will afford you the opportunity to do it. All right, so that's a look at the example portfolio. Hopefully in a couple of weeks, we'll be afforded the opportunity to take another look at the example portfolio as we've got those trades on for tomorrow for both Monster Beverage and Danaher, which should be pretty interesting. Hopefully that provides us with a good topical review for 2 weeks out. All right, so with that, I'm going to go ahead and wrap it up. I did want to remind you guys about my scan and uptrend and oversold. The one I've shared with you is specific to the S&P 500 and consumer staples. So consider when you load this and scan, you might tell it to not to scan in a group or not to intersect, and then save it as a generic scan for yourself. So keep that in mind, okay? Also, don't forget to follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. Love to have you follow there, of course. Dropped a bunch of charts in the X there today on a busy, busy day. So with that, as I note, I'll be back tomorrow morning for you for Trader Talk, and that'll be at market open, 9:30 a.m. Eastern tomorrow morning. Hope to see you for that one. If not, enjoy the rest of this week, and I look forward to catching up with you all again real soon.